David, happy Wednesday. 2-to-1 advancing to declining stocks, but kind of flattish opening. Not a lot of new highs. That's a selective rally, and that's a little bit of a problem for the technicians here. Let me just show you what's moving here. There you see the momentum names, tech and communication services. This is essentially technology put together. That's where the momentum has been all month. Growth stocks over value stocks, big caps over small caps. That's an inversion of what happened earlier in the year. Meantime, yield alternatives like REITs, that's a historic high for the real estate index there. Banks, sideways for months. Industrials, sideways for months. What's there typically? They're cyclicals. So you see that inversion. Growth, cyclicals tend to be value stocks. So there you see the inversion that we've been seeing here. In terms of why the market's at new highs, people act like they're baffled why, but the three things that matter to the stock market, I keep emphasizing over and over again: earnings, profit margin, and interest rates. And they've all colluded to sort of a perfect storm here. Earnings are not only at a record, but the estimates for the third and fourth quarter are still rising. That's the most important thing. Profit margins north of 13%. That's a historic record. It's been 9 to 11% for many, many years. Interest rates have been staying low on top of that. There's no wonder why the market is at a new high. One thing that's a concern, the technicians constantly are messaging me, I don't like the internals here, Bob, because they look at things like the advanced decline line. How many stocks are advancing versus declining on a daily level? That peaked back in June. The percentage of stocks at new highs peaked in March, believe it or not. In fact, we've only got 90 new highs down on the NYSE today. That's not much at all, given the fact that we're at new highs. And momentum, I look at the percentage of stocks above the 200-day moving average. That's a standard technical metric. Only 58% of the S&P is above the 200-day moving average. Is that a little, a lot? It was 90% back in February. So what does all of this tell you, these internals? Well, it tells you that the advance has been fairly selective in the last month or so. That's a concern to technicians. They want to see broad market advances. And you know what that means when we use the word, that's code, selective advance. When you get growth, it means FANG names. So with the S&P up 5%, 6% this quarter, you see the moves up here in these big names. The average top 5 names is up more than 10% for the month. So when you've got those 5 moving and they're more than 20% of the index, that's enough to move things forward. And that's what we call that selective advance, and why you're not seeing the advanced decline line move forward as much. In terms of what matters, a lot of people overnight kept messaging me saying, oh, the world's doing really well, Bob. The all-world index is doing well here. But remember, there's a lot of issues about what could go wrong with the rallies. Number one, we could still have a Fed communication misstep. We have not had one. They've been masterful in communicating what they want to do. We could have a new COVID variant emerging. We could have much further supply disruptions than we've had accelerating. And we could get sticky, not transient inflation. All this is out there, but the market is saying, for the moment, they're not concerned about it. Finally, just want to note a lot of discussions about the fact that the world's doing well. It's true, Europe is doing well. There's the big index for the whole world. If you want to own everything in the world, that's ACWI. That's the all world index. It is at a historic high. I don't like this index for a simple reason. It's really the United States, 60% United States. What you want to watch is ex-US. That's where the professionals go, and they put their money into things like the Vanguard International Index. This is the whole world, ex the United States. And here you're seeing much less of a move, sideways essentially. This is Hong Kong. This is France. This is Japan. The reason it's not doing as well as the rest of the world is, of course, Leslie, Japan and China have underperformed for months. So, Leslie, yes, world's doing better, Europe's doing better, but don't kid yourself. The U.S. is still outperforming everybody.